think as an investor, there's going to be some really hard times and there's going to be hopefully some good times. And if you use the hard times as an excuse to not persist, then you're never going to get to the good times.
Today's guest is Morgan Flager, managing partner at Silverton Partners. With over 25 years in venture capital and tech, Morgan shares deep insights on scaling startups, AI innovation, and building category-defining companies.
What that capitalization strategy allowed us to do was back less proven entrepreneurs, because we could sit there and say, like, you seem like a tenacious, gritty individual that I want to get behind, and we can talk about characteristics in a minute. But like, I'm also not taking a ton of risk, because I'm only going to write a $500K check or $1 million check, and I'm just going to see what happens. And we were able to be very successful with that strategy. It allowed us to just take more risk.
I'm curious if there was any moment or deal that really blew up and then shaped an instant kind of shift for you in sort of how you invest.
I think the biggest thing, kind of investment lesson learning for me was...
All right, welcome back to another episode of Built for This, the podcast where we explore the stories and strategies of the builders shaping the future of innovation and leadership. Today, I'm joined by Morgan Flager, managing partner at Silverton Partners, one of the most respected early-stage venture firms in the country and a cornerstone of Austin's explosive tech ecosystem. Over nearly 2 decades, Morgan has helped scale Silverton from a regional leader to a nationally recognized early-stage powerhouse, backing founders who have gone on to build market-defining companies across software, healthcare, fintech, and frontier sectors. Morgan is known for his sharp pattern recognition, disciplined approach to venture, and deep commitments to founder development. He brings a unique perspective on what makes a company endure, how markets evolve, and where the next generation of breakout opportunities will emerge. In this conversation, we're going to explore Morgan's unconventional path into venture, the lessons he's learned from evaluating thousands of founders, and the attributes that separate good companies from great ones, and his insights on shifting landscape of innovation in the U.S. Welcome.
Yeah, thanks for having me. A lot to cover. Excited to get into it.
I know, me too. There's so many different avenues we could go to, but I would love to just kind of start like I do with all my guests of kind of the origin story, where it all started from you. If you grew up knowing this is exactly what you're going to get into, or went a totally different path and then found yourself in something totally different. I find that those are kind of the magic moments that everybody really connects with.
Yeah, no, happy to get into that. So I was born and raised in Santa Cruz, California. Great place to grow up. On the beach, kind of surfer town. Most of my friends from high school actually never left. So I kind of get weird looks to, how'd you end up in Texas? Why'd you end up down there? But yeah, so grew up there, had a twin brother. We were super tight, went to Stanford together. So I think, going to college was probably the first time I even really thought about what I wanted to do from a career perspective. And like coming into Stanford, I was really fascinated by kind of genetics and opportunities in that field. And like, I think a lot of kids coming into college, you're not really exactly sure of like what you can do undergrad and what's possible. You kind of have this idea of like, oh, now I can do whatever I want and like go down all these interesting paths. So I was super interested in genetics, and I started out undergrad trying to kind of pursue that. And the closest thing that Stanford had in that area was like human biology. And most of the actual genetics classes were like graduate level classes, of which you can maybe take 1 or 2, but it certainly wasn't like a full curriculum. Human biology is also like the pre-med route. So it's very competitive. You kind of start out there, lots of people in classes that they're trying to kind of weed out and get to pursue other majors. So started out that direction, and then, kind of realized, hey, I can't really do much of what I want to do. I'm going to have to take a bunch of like organic chemistry and like other things, which I ended up doing anyway, but kind of wasn't exactly what I wanted. But I knew I still wanted to do something like technical and engineering. So I ended up in industrial engineering and management science, which kind of an interesting degree. I mean, it started out like kind of, factory floor optimization and process optimization. At Stanford, It's more of like business engineering. So there isn't as much kind of traditional like IE as there are some other places. When I started to kind of bend more towards tech, and it wasn't any kind of like planned path on my part to kind of get into it. It just being in Silicon Valley, being around like other students at Stanford, like a lot of people were pursuing that. A couple of my friends were CS majors, and they had an idea for a company and ended up kind of partnering up with them after sophomore year and pursuing it. And we first pursued it like through the business school competition. It's actually like undergrad and grad. It was basically a business plan competition. And we ended up winning that competition, and it came with like some nominal prize, like $25,000 or, I mean, I guess it wasn't nominal. Like when I was like 19 years old, that was a ton of money. Something like, oh, we were going to go do this post, this kind of competition. But a lot of the judges, just because of where Stanford is, were actual like venture capitalists and angel investors and stuff like that. And a couple of them kind of came up to us and kind of said, hey, like, we really think this has legs. You guys might want to think about pursuing this, either now or like after you graduate. And part of that was timing. So like this was like late 90s and you had kind of the frenzy of the dot-com, which we all know kind of how that ended. But at that time it was a bit like kind of 2021. It was easier to raise capital. There was a lot of optimism kind of around, where technology was headed and the opportunity. And especially as a Stanford student, a lot of people were kind of looking to throw money at smart kids with ideas. So we got very fortunate timing wise. And we ended up raising like 500K from Ram Shriram and Dave Duffield. Ram was like early Amazon exec, Google angel investor, and Dave Duffield started at PeopleSoft, we pursued that. We ended up getting an acquisition offer to sell the company. I think it was like around $100 million. We had conversations of whether we wanted to do that, decided not to, mainly at the advice of Ram and Dave, who were like, hey, this is, there's more of opportunity here than what you guys are seeing. We should keep going, don't sell early, really kind of pursue this and change the world. Then the market crashed. We ended up raising some more capital and we sold it, for a fraction of that. I think it was like under 30 million, which was still, it was a great experience. Obviously we didn't optimize financially that situation. It was never worth 100 million. It was kind of like an artificial valuation just because of the enthusiasm of the time, but it was real money at the time that we turned down. So as a VC and investor and operator, learning that at a young age, that it's not always up and to the right, even kind of super experienced, smart people, make mistakes from time to time. And in order to build that kind of value, more is required generally than just like an idea. You kind of really have to deliver it, because once the valuations kind of normalized, obviously we weren't in a position to realize the same. So a lot of great lessons there, but like once we raised that money, had that experience, even though it wasn't as rewarding financially as maybe it could have been, I was kind of hooked on tech and, doing startups. I wasn't really interested in becoming an investor at that point. I just kind of wanted to join another company really early.
You had your like engineering mindset, and any engineers I've worked with, hired, put them in, there's this like architecture perfectionism, wanting to kind of like dismantle to build, or, create something that functions differently. And I'm curious for you, was kind of start like getting into that initial competition where you were able to sort of see the way you looked at things in a like, oh, I can do this, take this ability that I have and do it in a much different way that like really just lights me up in a way I wasn't expecting?
Yeah, I mean, I would say, so I ended up doing more of the kind of financial planning and business model stuff within the startup versus like the hardcore engineering. We had like 4 folks initially from the CS side of things that were building most of the technology, but they kind of had a tech that they were kind of like in search of a like real world business problem for. And like essentially what we were doing was like a very early poor man's version of like Shopify or BigCommerce. So it was like templated e-commerce storefronts for SMBs. Like at that time, it's hard to imagine, but like setting up an e-commerce site was like $100,000 endeavor in like 1998, because you had to integrate like payment gateway and like all these other things. And the web technologies were obviously like clunkier and older. So it was like, hey, at that point, just because of where we were in the cycle, everyone's like, you're not a real business if you don't have a website, if you can't do commerce. And so all the smaller businesses were looking to get online as well. And we were kind of obviously playing into that. The technology they had wasn't like, hey, we want to do this particular thing. It was like, hey, we have this way of like basically replicating like various web functions, and we can integrate them in this way, but we can make them customized. And like, what should we do with that? And so there was a lot of effort that went into like, okay, how to apply this that's kind of a fit for what the market needs now. That is exciting because you're talking to customers, you're realizing that the existing solutions like don't solve the problem. And kind of when you step back from it and think about what's possible, that gets pretty exciting. And then when you get validation from like people in industry who are like pretty connected, that kind of say, oh, we agree with you, like this is an issue. And then you're empowered by raising money. It's like, hey, we're, these people that know a lot are giving us capital to go do this, it must be pretty exciting. Like all that's a really rewarding experience. And then, as all founders know, then the real kind of work starts, because it's, the materialization of like the vision that you have. So the next kind of year and a half was all about like, well, how do we bring in expert? Like, we're smart, undergrad, and what we had one grad CS person, but like had never built scaled enterprise applications. Like, we thought we knew, I don't know about everything, but we thought we knew a lot. And it's like, we find out really quickly, like, hey, there's some real skill gaps here. Like, how do we, address those? How do we recruit these senior people into the company? Like, what's the right time to do that? Who can we leverage to, help sell these candidates who have a bunch of other opportunities? And then, how do we translate, customers saying, hey, this is interesting, to orders and partnerships and all those kinds of things. And I wouldn't say we executed flawlessly, because we were very much learning, but we had a lot of enthusiasm. We were very eager to kind of get product to market and try things and figure it out. In retrospect, it's like, wouldn't have done it that way. We definitely put in our foot in the bucket there, and you can apply those. But at the time, we were just kind of learning as we go. And like, that's a scary time. It's a lot of work, it's a lot of stress, but it's also super exciting.
I think everybody has that when you have hindsight to like, oh, I could have, shortened that pain period for a little bit or done things differently, it could have turned out. I'm curious, for you, when you had the pivotal moment of being able to be acquired and then kind of holding, and then, having that event at, much less than kind of that initial deal first kind of on the table. You mentioned you were going to kind of start to look to join other companies, or what comes next, and sort of what kind of came in terms of a risk tolerance for you, or the rules that you were looking with before you decided to kind of create your own venture?
Yeah, so it's interesting. So like, after that experience, I thought about another, like, just doing something else on my own. But I think I learned in that is, hey, I knew I wanted to start other companies and do other things, or at least I thought I did at the
Yeah.
time. And I realized like how much we didn't know, like, as operators at that particular juncture. And so I was looking at my own stuff, but I was also looking at like, hey, what startups were my classmates involved with, or people that were like 5, 6 years ahead of me, where they're executing really well and they built like an amazing team, that might be like a learning opportunity and experience. So what I ended up doing, after kind of going back and like, doing a little work to finish getting my degree, was joining a company called Quintana, which was like a bootstrapped change management software vendor, for like lack of a better description. It was super interesting because it was well run. It was, the folks in that business were Stanford grads that I was connected to, but they were like several years ahead of me. And being bootstrapped was obviously way different than our journey. And it was really interesting at the time, because obviously we know what happened after the market crashed, is like venture funding was hard to get. A lot of the companies that were like very dependent on venture capital funding, that, most of them didn't have the business fundamentals behind it, like struggled over that period. It was a very painful period. But this company, having not been dependent on venture, was in a totally different place to be self-sustaining, to still grow, and to learn that discipline and see what kind of made that company successful, even if it was a little more measured, than some of the other venture investments that were made, was super illuminating. And that company ended up getting bought by Mercury Interactive for like 230 million or something like that.
Yeah.
So obviously bigger outcome. There wasn't a lot of dilution from investors. We ended up raising, I don't know, like 10 or $15 million, like maybe a year before we got bought. So it wasn't like kind of bootstrapped, but like at that point we already had 10+ million in revenue. Like, the founders in that business did really well. They ended up hiring this guy, Brian Plug, to run it, who was like a very senior operator at SAP, and just getting to see him up close, like his leadership style, how he ran the team, the discipline that he had, was just this super awesome experience. So really glad I kind of took the opportunity to kind of see some of that before like waiting kind of back in on my own, because to some extent, like, you don't know what you don't know, and you like what you're missing. Yeah. Then one more company called Ingrid Networks, which is also Stanford folks, like the head crypto guy at Stanford, this guy Dan Benet, had an algorithm that accelerated cryptographic functions and software, and like, so, SSL and a bunch of things that underpin commerce on the internet like depend on that, and we had a way to figure that out. Super hot startup at the time. Had venture funding right after I joined. I think I may have been like employee 10 or 11. And then what happened with that company was that all commoditized to hardware. So like the algorithms that did the crypto, instead of being done in software on the CPU, like there was dedicated ASICs from like Broadcom and others that did it. So it basically like took away, I would say, like our unique advantage, maybe
Yeah.
like a year and a half or 2 years into the business. And we end up like having to pivot. We turned it into like a dedicated key server that did a bunch of stuff for financial institutions to protect data at rest and a couple other things, and ended up having a successful outcome with that business as well, selling it to SafeNet, which is like a public security conglomerate. But like that was also a super interesting lesson because it's like it's not always a straight line. Oh shit moment, for lack of a better description, where it's like, hey, what we thought we were doing like isn't a thing anymore. So like we could give the money back, or we could like go figure something else out, and then to go through it in a way that where we did figure it out, at least to some extent, and still had a successful outcome with also like positive reinforcement of like just how much like tenacity and grit and resolve and also self-awareness of realizing when you're screwed and you have to like do something different versus like trying to do the same thing, which we see founders do from time to time. Also a great lesson. So kind of had three, very different, interesting kind of, I wouldn't say founder journeys because I wasn't the founder of those companies, but like early employee slash founder journeys, some of those businesses, which definitely shaped a lot of like my outlook as an investor as far as like what works and how it works and why.
And I'm curious in terms of experience. I know you mentioned a couple key things. Obviously, like no, like taking risks, like when things blow up, having to pivot, all big things on the entrepreneurial journey, whether you're the founder itself or part of the core team that is navigating all those things together. As you look at teams or founders, and you mentioned grit. And I've talked with a few people, is like grit something you can learn, or are you just innately like it's something you have? And I think grit is something you have, resilience is something you can build. But I'm curious, from your experiences early on, what kind of became sort of your either like core ethos or sort of non-negotiables when you're looking at companies and teams because of what you experienced through those?
I mean, super interesting question of like whether grit is an innate characteristic or something you learn. I might take the other side of that. It's something that I think can be learned, but not necessarily like when you're 30 or 40 years old. I think it has to happen sooner. Not saying it's impossible, at any age to have it, but like, like I grew up like doing athletics and like I wrestled at Stanford, and like encapsulate like grit into any one sport. Like wrestling might be it because it's super hard work. Like no one really cares about it. It isn't like a super big fan base sport. In the matches themselves, no matter how well conditioned you are, you're going to be unless you're wrestling someone who's like a completely different, like lower caliber than yourself, you're going to be exhausted. You're going to want to give up. There'll be ample opportunities to give up and, just kind of move on. And so if you have a desire to win, and you realize like, hey, this persistence has paid off for me in the past, like winning matches or doing whatever. This is one microcosm example. You start to realize like, hey, I may not even need to be better than every single person that I'm competing against, but if I don't give up and I just really see this through, like that kind of, might be the deciding factor. And I've seen that be the deciding factor a bunch. And so I'd say part of it for me came like earlier on through like activities like that. But then in a company, it's similar, like, after we pulled that offer and didn't take the 100 million, offer, and it was obvious like after the market crashed that we weren't gonna get back to that milestone, or at least it was to me. So it's like, okay, well, we can like give up and get nothing, or we can like see this through. And like part of me at the time, like I don't think I had the foresight or wisdom to know that like, hey, if we just keep butts here, that we're going to figure it out. It was more of like just a commitment to my investors. It's like, hey, if I'm going to take like money from anybody, to me, it's like, okay, well, I have to make sure that I'm the best fiduciary of that capital. And like, it's my reputation, as to what happens with this investment. And like, we may not be successful, but the last thing I'm going to do is like tell people like we're not successful because I'm tired and I'm going to give up on this, which I don't know if that's like a good attribute or a bad attribute, honestly.
Good, because of so many entrepreneurs I work with, a big thing they always look at or want to kind of test for, back to the grid, is formative experiences. And generally, if you were a competitive athlete, you've gone up against somebody tougher, you've been knocked down multiple times, even let's just say you weren't like that, made it to, like the pros of anything else. But if you were consistent enough to keep going, it's that ability to kind of keep pushing through and see through the other side to an outcome. And I think, especially in early stage or entrepreneurial environments, the pace and the pivots can be so quick and so intense depending on who you're working with, that I think that if you aren't used to experiencing like high levels of like stress and pushback and like failing or like winning sometimes and losing the other, it's much easier, and I see it all the time for people, they'll just walk away or they'll go to a larger company where there just isn't that environment.
Yeah.
And I think there's always like a certain type of personality, like, and I am one of them, like, I love being in hyper growth environments. I love the pressure, the stress, the like figuring it out, but it's not for everybody.
Yeah, I don't know. I mean, part of me, and maybe this is like credit to my parents and just how I was raised, but like, when things like the bloom started to come off, the rose, there was definitely opportunities to be like, well, there's lots of excuses you can make, right? It's like, hey, the market crashed, it killed whatever the number is, 70% of tech companies. Like, we're one of them. Like, too bad. Sorry. I just never had that bone, I guess. So I was always like lying on the ground, like not, able to kind of do anything. And like it paid off, not in the sense that like that outcome was some enormous outcome. Like it wasn't what investors wanted. Like they got, their money, but like, it wasn't what anybody envisioned, but there was like honor in like seeing it through. At least that's the way I looked at it. And then at Ingrian, similar story, could have given it back, figured it out. Probably again, not like the outcome that everyone was like, it wasn't a home run, but everyone made a multiple, of their money and credibility of like, hey, I interfaced with a lot of the VCs at Ingrian, which was the security company that we ended up selling to SafeNet. And I was part of like the sale process and stuff like that. I could just see the appreciation of like, like we really appreciated the commitment. And it wasn't just me, it was the whole company and the whole leadership team that people made from this like, oh shit moment to like, no, we're going to see this through and we're going to make it happen. And then the employees as well, like no one made a ton of money out of that because it was only, I forgot, like an $80 million outcome or something like that. Common made money, the people that had like put their heart and soul into this business, like everybody made money, and it's just such a better outcome than the alternative. And so I kind of had these examples of like, hey, if you're able to persist and you're able to see things through, like good things happen. And then when you're evaluating businesses, it's kind of like, okay, well, I know, now from not only my experience, but from a bunch of founders, like what characteristics do you see in people that kind of give you the feeling that folks who are going to persist and find a way? Because especially in these markets now where it's like, it's like 2021, like everyone's getting rich and it's easy. And then like 2023, it's like, oh, this is really hard and everybody's going out of business. And now, depending on what sector you're in, it's like AI and it's easy again. And everybody's like doing well. And like, that's just within like a 5-year period. And so there's going to be some really hard times and there's going to be, hopefully some good times. And if you use, the hard times as an excuse to not persist, then you're never going to get to the good times. And by the way, like not every story has a happy ending. Like mine had marginally happy endings, and there's plenty of examples of people that really did everything they could and it just ended up not working. But I think as an investor, like, and we've had those within our portfolio, like I will take those calls and look to back those founders, again, because like it's a hard job. And sometimes like you're just in the wrong market or at the wrong time, and it's not an execution or determination thing. It's just not in the cards. The perception, or at least the perception I have, is like, hey, there may have been something there. It was, you're going to have to grind it out and probably wasn't going to be a ginormous outcome for anyone, but they kind of punched out. And again, I don't fault people for doing whatever they need to do, for their family or their situation. Like it's not my decision, but like, that's a different story. It's like, hey, that person's coming back and asking for something and, hit the easy button earlier, I do think about it because,
For sure.
about like, hey, during this journey, there's going to be several opportunities to hit the easy button. And if I think you're the kind of person that's going to do that, like maybe, the capital should go to work elsewhere.
Yeah. And so talk to me a bit about, the moment that Silverton came to be, and then I guess kind of moving out of the Silicon Valley area and kind of focusing more on Austin?
Definitely kind of haphazard story, I would say. So I was at FTV Capital, and I was a software predominantly and payments investor there. At the time, we had a growth fund, which was like 420 million, which is funny because like, there are seed funds out there that are 420 million. And like, I don't know what FTV's last fund was, but maybe it was 4 billion is a big number. So anyway, I was there, and John Callahan, who was one of my investors at Ingrian, was starting True Ventures at the time. This is back in like maybe 2005. And because of the experience he had with me at Ingrian in selling the company, which I think was positive, like he was interested in, maybe working with me again. And he had talked about like, hey, if I get this True Ventures thing going, would you want to come on and, be one of the first employees or the first employee there? And I had a lot of respect for him, and I was super interested in that. So that day eventually came and gave me that offer. And FTV also, interestingly, like wanted to keep me, which was like flattering. And so like I was trying to decide what I wanted to do. And in the Valley, probably still the case today, but at that time, like still pretty tight-knit community on the venture side. There aren't a ton of people. So everyone I would talk to, either knew John really well or they knew somebody at FTV. And I always felt like I was getting like kind of slanted advice on like wherever they had the best relationship or whatever. So I was like, oh, I'm like, and I never really spent much time in Austin. I think I'd been once. I had a buddy that was Stanford undergrad buddy who was down in Austin. He was telling me about this guy, Bill Wood, who had co-founded Austin Ventures, which was like the biggest firm in the Southwest for, I don't know, 20, 30 years. He was a managing partner there. And so it's like, hey, you should ask Bill, because Bill doesn't know John Callahan. He doesn't know FTV. He's just this like Texas guy who's connected differently. So I flew down to hang out with Charlie, and then I met Bill and I asked him his opinion. The opportunities were in front of me, which is a great spot to be in. And he basically said, that he had stepped out of Austin Ventures mainly because they had gone later stage and kind of diversified their strategy. He was starting a new firm in Austin that was like early stage focus, which was like a passion of mine. I really wanted to get on the early stage side. And he had a commitment, I think from Harvard Management at that time, which is like the university endowment, back in 2005, 6, when this was, you could argue they were like a top 3 LP investor that you would want to have, still today. And that was interesting. And then like, he didn't have like a built out team, and he was obviously like not in the Valley. And so like, I started thinking about that for a minute, which wasn't at all anything I had planned. And I really was trying to optimize for 2 things. One, kind of growing up in the Valley, I have learned like, hey, it's an asymmetric game. Like, there's a handful of outcomes that really drive venture returns, the power law, all that kind of stuff that people talk a lot about. And, those deals generally accrue to the very top tier investors, and, my perception, which may have been wrong at the time, was like, we're at FTV, we're doing these things, but I wouldn't put us in the category at the time of like Sequoia and Kleiner and Mayfield and like all the firms of yore that were kind of in that category. And I kind of looked at like, well, how are we gonna, like, can we realistically break into that category? If I were to stay at FTV or, even join John, like what's the hurdles to breaking into that category? And like my perception was at that time, like significant, right? Because the track records of those firms and kind of the deep roots that they had, and all those sorts of things. So I thought that was hard. And then a lot of the firms that I had offers, from like, FTV or even True, they had built out teams. And so like the upward mobility there was like, okay, at some point, so-and-so will retire or so-and-so will be fired or will grow. And like, that'll create some upward mobility. And I had just seen people stuck like somewhere in the middle of that mobility cycle where it's like, and that always exists. But, I guess with Bill and at Silverton, like it was just the 2 of us. And so it's like, hey, well, if I do well, like, and I think for some people that would have been scary because it's like, okay, well, now I also have a single source on this one guy and this like small organization. And so anyway, like it was a combination of those 2 things, which is like, hey, Bill probably has the best reputation of anybody, certainly in Austin, in Texas, long track record as an investor here. we've got money from arguably one of the top LPs. Like that's interesting. Like being in on the ground floor, having kind of no caps on like upward mobility, like that's super interesting. And so like, what do you have to believe? Like, there's enough happening in Austin to support a firm, like an early stage investing firm. Like, I concluded that there was, but that was kind of like a leap of faith at the time we had to do, which is like become the best firm in Austin. Because certainly at that time, I think it's a little bit different today, but at that time, like if you weren't the top firm in Austin, like which was a much smaller geo, it's like you might as well just like, at least in my view, like you might as well pack up your bags and like go home, because that just makes it a lot less interesting. And so I kind of viewed it as a challenge, where it's like, hey, the two of us doing this thing, like I think we can do that. And, like I'd be surprised if we can't. And it was probably a little bit arrogant and maybe optimistic, like in retrospect, to assume that we could just kind of walk in and do that. But again, assisted a lot by Bill and his reputation and network. I feel like we were able to do that, over the next kind of 5 to 7 years. And part of it was luck in terms of Austin's growth and the ecosystem becoming more interesting, which like I think was part of my thesis, but the data that I had I would call it more of like a
Hunch?
guess hunch rather than like, I had some like master, crystal ball of like the way things were going to evolve. It probably evolved slightly ahead of like what I would have thought like at that time, I think, which was just pure luck.
And how did you look at it? And it's, like Austin has become this like new hub for sure of, where, VCs or like firms were kind of setting up shop and that whole ecosystem there. So how are you looking at, or what were you maybe seeing that potentially others didn't see and kind of took that road of like, no, don't have it. I am going to take that road of like pack up my bags and go set up shop somewhere else where I have a higher possibility of success.
Yeah. I mean, I think if you look at the folks that have come here, the investor side, like bucket, and there's like a bunch of different stages and styles of firms, and won't get into that,
Mhm.
but like, there are people that came here for like kind of tax and lifestyle reasons, which is like, obviously Texas is a lower tax state than California, especially if you're making a good amount of money. And if you're a partner, or managing person at like one of these bigger firms, like you're probably making a good amount of money, and that's a big consideration. But it wasn't necessarily part of like an investment thesis, which is like, hey, we're moving here because we're going to go invest 50% of our fund in Austin. It was more like, we're national anyway. We're going to do the same thing in Austin as we would in Silicon Valley, but it's cheaper from a tax perspective to do it. And I think a number of firms moved here for those reasons. And then there were other people, as the opportunity here grew, either set up shop or moved here for the purpose of like investing in Austin. And like, if I were to proportionally like put people in the buckets, I'd say like 80% of people that moved here were the former. So like moving here for like a political or tax reason that had nothing to do with investment strategy. And maybe 20% of the people that moved here like actually wanted to make Austin like a huge hub of what they were trying to do. And so in some ways, at the early stage, like the competitive landscape hasn't changed all that much, because like if we're competing with, ABC, just to pick them out, like anyway, when they were in, the Valley, like we're still competing with them when they were in Austin. By the way, we don't really compete with ABC very much because we just have different tastes of what we want to do. But just like as an example of like a firm that's moved here, and a lot of people kind of fall in that. I think what we've seen lately is, when I moved here in '06, like Austin was pretty much enterprise software and semiconductor. And now it's like fintech, insurtech, health tech, like increasingly now like robotics, like hard tech or frontier tech or whatever you want to call it. Defense tech, argue Austin's probably the hottest market for defense tech, which is like a new emerging sector like in the country. And so like when those new verticals, for lack of a better word, come about, then you have like specialist firms that are sprouting up to specifically address like those verticals, which is super exciting. Like, I went to a pitch today for like a new firm called Overwatch VC. There's, a lot of like frontier tech as well as defense tech and stuff like that. And they have a really interesting portfolio, and they have a combination of one guy who's been here for a long time and some other folks that moved in from out of town. So, from a competitive standpoint, I'd say we're competing more with specialized folks that have moved here because of particular like interests like defense tech than we are like a bunch of generalist early stage firms that are just like bouncing around doing stuff, in Austin. And we've really tried to keep our fund size where like our primary mode is seed investing, not to be advantaged competitively against other firms that are here, but like the bigger platforms, like an Andreessen or Lightspeed or those sorts of folks, like for them to do a $3 million seed investment in Austin, isn't really like core to their strategy. Not that they're never going to do that. But like, when you have a $2 billion fund, you just can't manage those style of investments, especially when they're not in geo. And so we'd rather kind of be the local partner that serves those deals up to those firms more at the Series A stage, having gotten in early. And so part of our fund strategy over the years has been to supply the round of capital ahead of kind of the national folks that are kind of, covering Austin by flying in.
And I'm curious, as you started to kind of gain your footing with Silverton and build that portfolio and focus on that seed stage, kind of going back to looking at, founders and traits and kind of, your experience of what worked and what didn't, how did you kind of translate that into how you're evaluating leadership as you look through deals and who you will and will not invest in?
Yeah. 2007 or 8, which is like, a couple of years into like our journey at Silverton, we had a little bit of a pivot in strategy. And like, I would say prior to that, the strategy for early stage venture was like, hey, we're going to write like a $4 or $5 million check into like a seed stage company, generally with like a pretty experienced founder, at least on the enterprise software side. Consumer was different, and there were younger folks and less experienced folks that were doing stuff there. And there was early signs of traction that were different. But on the enterprise side, it kind of looked like that, like, and we did SailPoint, which is now like, a big public company. Mark McLean had done 2 other companies before, like Tivoli and Waveset, and we wrote them, a $3 or $4 million check. And it was like very traditional. And I don't know if innovating is the right word, but like now it's pretty common, like these like pre-seed checks or like really early checks from venture firms. Like there wasn't a lot of that going on back at like 2007, 8. Like there were some angels and other folks doing that, but like the firms weren't really doing much of that at the time. And so to answer your question about like characteristics of founders, like what that capitalization strategy allowed us to do was back less proven entrepreneurs, because we could sit there and say like, hey, I'm going to write you a 500K. Like, I really like you. I like the idea. Like, you seem like a tenacious, gritty individual that I want to get behind. And we can talk about characteristics in a minute. But like, I'm also not taking a ton of risk, because I'm only going to write a 500K check or $1 million check at that time, I think our funds were $75 million. And I'm just going to see what happens. And I'm going to look at traction, and I'm going to look at how you behave, and I'm going to look at your thesis on the market. And does it evolve kind of the way we thought it would? And I'm going to follow that check up with obviously more money, if it's working. And we were able to be very successful with that strategy, partly because, we picked good folks, but more so like it allowed us to just take more risk. We backed this company called Sparefoot. It's now called Storable, and it's a multi-billion-dollar marketplace and software business. When I wrote them their first check, I think they were like 21 or 22 years old. And it was like a tranched 500K investment at like $1.7 million valuation. And it was like, here's 300K. And then, if we can get X number of transactions on the marketplace in the next 6 months, like I'll give you another, 200 or 300K, which sounds kind of almost like ridiculous now to like structure like that size of investment. But like these guys had they'd never been at a company, and it was like B2B marketplace for self-storage. Like
Structuring a line of credit, basically, like, here's a milestone and I'll get you more money.
yeah, and we did another, kind of $1 million investment in this company, WP Engine, which is still private. And it was just kind of like, hey, we like it, go prove it. And I think we're able to do some of those also because, the ecosystem was less competitive. Sometimes in the busier ecosystems, it's like, well, if it's at all interesting, like maybe someone's offering them like $2 million instead of 500K. Like if you're a founder, that probably like sounds better, and you go take that deal instead. But it enforced two things. It allowed us to take risk, and then it also, by definition, made the companies capital efficient. Because if you only have that amount of capital, like it's hard to waste it because you really only have money to spend on like necessity items. Which, as that played out through the thesis, made those companies super attractive because to later stage venture investors and private equity firms, I think when Silver Lake came into WP Engine, like we had $100 million of revenue, and I think the company had only raised like 10 or $15 million or like some small amount of money. And like they just weren't used to seeing that out of the valley because like you'd see plenty of $100 million businesses out of the valley, but most of them had raised 200 million to kind of get to that point, I think is what started making people interested in Austin, like especially on the later stage side, because they're like, oh man, like there's some really good companies coming out of there and like they're doing really well for investors because they're able to achieve these things without burning through a ton of capital. And, that kind of started feeding on itself and like the ecosystem started getting robust, which helped us because like the issues we had early days was getting people to write the second and third and fourth checks into our business. And like those kind of went away as, our relationships got better and Austin kind of became more of a known quantity.
Yeah. And I imagine too, just kind of based on your conversations of working with people and understanding different leaders of like the discipline when like more experienced leaders come in, let's just say earlier stage companies to run things in a certain way and to be able to learn and adapt from that. And I know that you mentioned, some of those deals don't work out and like being on that phone and like, hey, bad timing or the market wasn't ready for you yet. I'm curious, if there was any moment or deal that really like blew up and then shaped like an instant kind of shift for you in sort of how you invest or how you look at things based on like, I'll call it a milestone or one of those core memory experiences.
I mean, I think the biggest thing kind of investment lesson learning for me was like our first fund, which was like a 2006, early 2006 vintage, it ended up being like a 3.2x fund. Sounds like very pedestrian because the great financial crisis was in there for early stage venture, like Cambridge benchmarks, like funds by vintage. And like for 2006, it's a crappy vintage. And so like 3.2x is actually like a top 5% fund for that vintage. And so we were kind of in the later innings of that fund. And Jamie Harvard said, hey, like we're happy with the performance of this fund, but like just so you guys know, like your capital allocation strategy is like terrible. And I was like, well, that's interesting. Like you don't hear a lot of complaints, from investors when, you produce results. It's like if you're operating a company and like you're hitting your numbers, like, most times people just kind of like keep their mouth shut and nod or pat you on the back. You don't get a lot of criticism. So I was super interested in what he had to say because I'm like, okay, well, if he's going to step out and say this, like he probably has some conviction about it. And I went and looked at we call it our SIC, but it's basically like our statement of investments and capital. Top 3 investments, which were like $7 to $8.5 million checks for us in a $75 million fund. So like usually in those funds, you don't want to go above 10% of capital in one investment. And so we were like at the max or close to the max in like all 3 of these deals. And I think the best of those deals, we had like a 1.4 Exxon. And the other ones were like returning capital or like not quite returning capital. And then we had like our better deals, like I mentioned, like Sparefoot and WP Engine and some of the other ones where we had like $2-3 million and we had them like a 30 or 40x or whatever it was at that time. He's right. Like, how the hell did we do this? Like everyone says like, starve your losers and feed your winners or whatever, like analogy. And like, that's what we do. And that's our strategy. And I'd say like most of the time when you actually look at, that statement of capital, like that isn't true. For a lot of people, they say that, but they actually aren't able to like pull it off in practice because it's hard. And what I realized is like, well, like, hey, we're smart people and we have knowledge of these companies and we have knowledge of the teams and we're the first money in pretty much. And so like, we should know better than anybody, whether we want to double down on this investment or not. And we screwed it up. And so I'm like, gosh, like how did that happen? And I'll tell you how it happened. And it's like the bad companies or the companies that don't produce, like the best financial results, usually like they need investment, right? Because they're not quite growing fast enough or they're not as profitable or there's more friction with the go-to-market motion. So like they aren't businesses where you could just be like, oh, we'll just operate profitably and they're just gonna like grow at an interesting rate like of their own devices. Like they need fuel to like be the engine. Because their performance isn't awesome, like there isn't a long line of investors out there who are like wanting to write those checks. And so you get into this spot, and how we did reserves at the time was like, hey, we'll write a $3 million check or whatever, and we're going to reserve $3 million or $4 million for that company. And at the time, all we did is like, whoever partner did that deal, like you get to decide when you want to use those reserves. Like it's up to you. And like whenever the company needs it, like you use it. And so like the people that were on those deals use those reserves like relatively quickly because of all the dynamics I was just talking about. And then you have like 5-6 million in these deals in a $7 million fund. And now it's like, oh, we only need another $1.5 million to like get to profitability or get to a sale of the company. And you're like, oh shit, well, we have 6 million in it. We can't just let it go to zero. Like we've got to put in another $1 million, and then you get $7.6 million in the company that only returns like 1.2x. And so how we changed it was we made the reserves like super dynamic. So like we may initially put 3 or 4 million on reserves on a $3 million investment, but we revisit it every quarter, and every partner and junior investment professional like ranks the companies like from 1 to N on like what they're most excited about putting more money into. And then our CFO tabulates like an anonymized version of that, which is like a crowdsourced sort of ranking. And then the discussion is like, how do we move reserves from the bottom third to the top third? And we do it every quarter. Like you could have raised capital from us 2 months ago and like you're getting ranked. And so like what that it provides for is one, it shovels the capital in the right way, presuming the common wisdom is accurate, often the case. And two, it gives people a lot of lead time. So if you get reserves taken away from your company, like, so meaning like you can't participate or you can't lead the next financing, like you'll generally have like a year or a year and a half in advance of that financing to like figure that out and make alternate plans. So you could set expectations with the founder that, hey, unless performance changes, like we're not going to be able to do this, which still doesn't make for like a super pleasant conversation because everyone wants you just to blindly write checks, and or most people want that. But like at least you're giving people the lead time, because what destroys your reputation is when they think they need it and they're out of cash in like 4 months, and they're kind of implicitly assuming you're going to support them, and then you tell them like, well, actually we don't have anything, and then they're like, well, we don't even have time to run a process and this and that. So our capitalization strategy improved, and I would say like, oh God, it seems like such common sense that like people would run firms and processes like not maybe exactly like that, but in that dimension. But like in a lot of firms, like it's still much closer to what I described like we did initially than it is kind of what I described later. And how people manage that is like, oh, well, then if a partner, makes the wrong decision and the outcome, like then we just like fire the partner. It's like, okay, well, like you can do that, but like it's going to take you 8 years to figure that out, or 6 years or whatever. And like in the next 6 years, like that person's gonna.
Well, no, it's funny that you bring up capital allocation. Not too long ago, somebody I was actually speaking to for this podcast in particular recommended reading The Outsiders. And then I'm in like the dovetail kind of finishing that book, but I expanded my knowledge much more on that topic and understanding the different ways and why they were so unique in terms of how they ran their companies and the different strategies. But kind of like the big overlooked thing is capital allocation, how you're doing it and measuring it in different ways to do that. So it's funny that you bring that up. Very, very coincidental in terms of what I'm kind of thinking about right now and learning more about. And I'm curious because we are in this AI bubble, and there's, I think it's not like, Peter Thiel taking a big bet on like that bubble's going to burst and like shorting other sides, and how everything's going to blow up, which inevitably when any new tech thing comes in, there is going to be that break of it not being the hottest thing to ever hit, the earth. I'm just curious, from your perspective, how you're looking at AI from an early stage, like investment perspective, and how that's kind of either shaped the landscape and or focus of, the deals that you're getting involved in.
I'd say it's probably the most interesting investment opportunity that like I'll see like over my investing career. So like, the prior 23 years plus whatever I've got left, another like 15 years or 20 years or whatever it is. I'm a buyer of kind of the long-term potential of the opportunity. So I don't think it's like smoke and mirrors and it's going to like go away and not be interesting. It is a like I don't know if minefield is the right word, but it's a precarious like opportunity to invest in these days. And I'll tell you like our high level strategy because I think sitting it out or shorting it. I mean, obviously we're a venture firm, we're not going to short it, but like even personally, like I don't think either of those are probably the right strategies either because people eventually there will be an adjustment, right? And the people that call it now and if that happens 3 years from now are going to declare, victory. But like what I would say is like, but the market could run up another 100% between now and 3 years from now. And it might only decline 30% like when it adjusts and like you're still a loser, in that scenario. And so picking when is a lot more important than just having a feeling that it might happen, which is hard. Like picking when is the hardest thing. So how we're playing it is we're trying to invest in it without paying the like crazy multiples that are present in a lot of deals getting done. And it's like, oh, great. Like, that sounds good. Like, how do you do that? Like, how do you find those deals? And my high level description is one, like it's helpful to have a smaller fund in this circumstance. I mean, at least in some ways, because if you're in some companies that run up a lot in a short period of time, like you can sell into those financings and like take some risk off, which doesn't necessarily mean you're like, not excited about there's opportunities. It's just like, hey, we're gonna be smart and we're gonna put some gains, but more so like we can kind of play in some areas that other folks can't. And what we're doing a lot of is like vertical, like agentic AI software, and we're doing it in categories that are generally like sub a billion, at least currently defined, like with software.
Hmm.
And so those are areas where like the bigger platforms, Andreessen, Lightspeed, et cetera, like they're not really that interested in those categories because, they have to have multi-billion dollar or times $1 billion outcomes to like move the needle for those funds. And like those almost always happen within kind of larger TAM areas. So they're not really playing there as much, but also we believe that like the TAM will expand within these categories because not only are we replacing software that exists within these categories, but we're also replacing some labor. So like we did a company called Uptick, which is a agentic AI financial services platform, and they do a lot with like loan underwriting software and workflow today. And so like if you look at a bank, they might spend $5 million on loan underwriting software, but they may have like $60 million a year of labor, running the software, doing other functions that the software doesn't take into account. And like, not that all that labor is going to go away, but like part of AI is efficiency within kind of how much more the software can do and workflow. And so like, okay, so maybe there's another 5 to 10 million that isn't there today that's going to replace some of the labor, that's in that market. And so now, a market that might be 700 million becomes 1.5 billion or 2 billion. So it's not just, hey, we're going after smaller areas, but also we're going after areas where we think the TAM is expanding significantly. And we're trying to pay, it's tough, but we're trying to pay like 14 to 20 times revenue. And it seems like, okay, well, like you're kind of like splitting hairs there, but like our view is there's a ton of M&A activity that's going to go on. And like most of those deals are going to be sub $1 billion. So if your entry point on a seed deal is like 200 million, like you're out of that market. Now you can still go create a $10 billion company and like that works out great for everybody. The issue is there just aren't that many of those. Like if you look at the last 20 years, there are roughly like 30 companies that were venture funded that achieved a $10 billion plus valuation that started within that period. And there were 70 deals this year that were, going into companies at over $1 billion. So it's like in 20 years, there's 30 and people are betting with pretty much all of those 70 this year that they're going to have one of the 30. And so like maybe there's 2 or 3 a year and there's 70 deals getting done. And like, I'm not a betting man, but like those odds, I think I'm not trying to be negative on it because I do think maybe there'll be 50 or 60 instead of 30 because that AI opportunity is so significant and it's going to crown a lot more winners.
Yep.
But still the math gets pretty thin. And so we're trying to play a game where we don't require the math to change super dramatically in order to be successful. And we don't want to play a game where we're buying lottery tickets, where it's like, hey, if we have the 1 in 100, then we'll celebrate in the street. And if not, like, we'll tuck our tails between our legs and go out of business. Like, we pride ourselves in like every fund performing. And maybe that's a mistake in our strategy and we should be taking more risk, but like, it's just not in our DNA. So we tend, I mean, to say you're conservative as an early stage venture firm is like a bit of a misnomer, but we tend to be a little bit more on the conservative side.
Yeah. And talk to me about kind of, in this competitive landscape with, the reality of just what AI is doing and streamlining companies, but also from a human perspective, eliminating roles, and that will continue to grow. How are you kind of looking at that from sort of a founder and investor relationship evolving of like, I guess maybe potentially like teams growing, but then a lot of cuts happening and maybe their philosophy around how those people are going to be either retrained and like outsourced elsewhere or kind of, I guess, more the ethics and like ethos of what's coming next.
I guess what I would say is like, I'm a huge believer in like the resilience of the human spirit. And like, anytime people have these like super dark forecasts of like, oh, 40% unemployment and like, AI is going to put like, people find a way and like people will be doing different things. Like there's roles that are going to be out there 10, 15 years that you can't even envision today. And like anybody that thinks they can talk about it, I'm like, I'll listen, but you probably have no idea like what you're talking about. But like, just like water seeks its own level and finds its way, like people find a way to, have significance and have meaningful work and move forward. And so like, broadly speaking, like I'm a believer in that. And like, I really hope I'm not wrong in that because if I am like this, the future is not a very interesting place. But beyond that, like within tech companies, this is going to sound maybe a little bit harsh, but like, I think it's important if you can see the future and the future involves like efficiency at a certain level. And like, software is competitive, right? Like any tech industry, it's a competitive industry and it's a worldwide industry. So you're not just competing against the person across the street or the person in the same state or even the person in the same country. So I wouldn't say it's like a zero sum game, but it's kind of close to it, right? Like, if you're not the winner or one of the few winners, like being on the bottom end of that totem pole or whatever is like painful. And it probably means like people losing their jobs or, investors losing a bunch of money. So the reason why I kind of give that setup is, so if you're a company today and, you're operating with 5 or 10% EBITDA margins and you're not growing that quickly, but through the application of AI and maybe the elimination of some roles, maybe you could be operating at 30% EBITDA margins, right? Like you could take like the humanitarian perspective of like, well, do I really need to operate at, 30% EBITDA margins? Like, I don't care that much about my investors, just to kind of put it on the table. Like, I just want to employ people and like, I want to make a good salary and I want to, maybe I even have the mantle of like, I'm doing good for the world. And my argument would be like, you can have that point of view, but like, your entire company will probably be out of business 7 or 8 years from now. And instead of letting go 30% of your workforce, like you're going to be letting go, 70 to 100% of your workforce. And it's kind of like, like if you don't get your ship in order, like the whole ship goes down and like everybody's swimming. So like, unless you're willing to like tolerate that risk, which is real, like you just kind of have to get on the program. And as unpleasant as that is, like, it's just a reality of like doing business. And that doesn't mean you have to do it in like a heartless, way, or even that like, in growth companies, it's like, hey, we can be more efficient, but we're not gonna let people go. We may be like hiring here and letting go here, but like in general, we're still net hirers because if we're growing at 100 or 200%, even though we're getting more efficient, we're still hiring people. But in a company that's not experiencing that growth, it probably does mean letting folks go. And I don't know, maybe the perverse justification that I have in addition to what I've already offered is like, that's probably in some ways like a good thing for those people that are being let go, because like what the market, I'm like a big free market person. What the market is basically saying is like, the market is not rewarding the work you're doing at company XYZ. Like your stock isn't appreciating in value. Like you're probably not being paid a crazy amount of money. Like the world is kind of telling you like, go someplace else that has a better opportunity for success, where your skills are going to be more maximized and utilized. And like, again, maybe it's like false justification, but like, I think that's part of like free markets and capital markets is like, you want to force the labor out of, the assets that are struggling, and force those people to then go find their way to better growth elements of the market. And if you don't have that, like there's this stasis that can exist, which isn't productive to like moving things forward. So, it's definitely not all roses and, balloons, when you start talking about that stuff, but I do think it's the right.
And I'm curious, from your perspective and kind of, looping back to, founder traits and then what people in investments are looking for, what do you think is going to really, as we, are emerging to all these emerging markets, new tech, new teams, new companies, new ways of doing anything, what's going to kind of separate the founders and the funds sort of for this next area in terms of who succeeds and who doesn't?
Again, if you fast forward 10 or 15 years, these efficiencies and operating improvements through AI, I think will be very commonplace. Like the best practices will be established, like the path will be pretty well defined, and, more or less everybody will be doing it. But between here and there, like there are going to be people who capture it first, and there are huge rewards for those that capture it first. And so, within our portfolio, because it is moving so fast and people are figuring things out that are super useful, it's like, well, how do you share those kind of insights or, secrets with other people within the portfolio? Like, they're not going to want to share with their competitors and, maybe more broadly, but like, at least within our portfolio, it's kind of like, hey, if everyone has, a new code development tool or technology or methodology or whatever, like I want that shared like broadly within, the portfolio. If someone has a new, go-to-market accelerant where they're, using, AI for kind of lead gen or like whatever kind of tool or tech, like, because if you have that 2 years before, a competitor, like your efficiency is going to be better. You're going to be more attractive to investors. You'll be on a capital raising trajectory that separates you from others. And so to some extent, it kind of defines like win and losing is like how much experimentation and knowledge can be transferred, and like how willing are people to embrace these new things and iterate and, get to an efficient way. So like the other side is like, what about like what you choose to do? Like we're on the seed side. So like, obviously we're funding every day, like new entrants into the market. And at the end of the day, what investors value a lot more than like profitability or efficiency, it's like growth, the new market opportunities. And so like, I mentioned, everyone talks about how interesting AI is. Like to put it in perspective, the forecast for like basically AI software in 2028 is like, I think it's like 407 billion. Like right now, the entire application like software market is like 420 something. So like basically it's saying in like 3 years, AI software market is going to equal the entire software market today. When I see numbers like that, like my immediate thought is like, well, that's, just optimistic BS, right? And then you start to kind of decompose it and you're like, well, not all of that is net new, because there are existing incumbents who are going to add AI functionality to their software, and they're going to call it, now we're an AI business, and like that's going to be some percentage of the market. There will be a reasonably big percentage that are going to be like new native, born and raised AI businesses that take share from incumbents. Like that's what we're most excited about. And then you're also going to be taking share from the $10 trillion labor market, as I talked about before. And so we're like, when you put all those things together, you're kind of like, well, maybe that forecast like isn't so crazy. And you start to be like, okay, like, we need to like pay attention, to this and believe in it. So we're kind of operating under like the thesis that like that's going to happen. So like if you're not incorporating this stuff into your software in the next like 2 or 3 years, like you're now like in the small minority in the market and probably like just waiting to be disrupted. Like I'm not sure how insightful that is, because like a lot of people are kind of telling that story, and we tend to be subscribers, but like when you put the numbers to it, you're like things are really shifting in a massive way. Whether we're overbuilding, data center infrastructure, and like whether you should short Nvidia and like all those things. Like I'm not gonna get into all that, but like the forecast for like what is gonna go on the application side within AI software is like pretty massive, and we'll see how reality holds to forecast.
And before we kind of close things out with some rapid fire questions, what is the thing in terms of yourself, your team, and Silverton in general that you're kind of the most excited about right now?
Probably the team. Like one of the things that I'm most excited about is like we've never had an investment professional like leave Silverton in 20 years, which is crazy. Now, we've had a couple people be let go, so it's not like, oh, we're some perfect place where nothing goes wrong. But like, like when you start talking about a company and you're like, oh, you're a 20-year-old company and you've never had anybody leave, you've only like let people go. It's like, that almost seems unbelievable. And to some extent it is, because we only have 13 employees. So like if we had 1,000 employees or even like 60 or 70 employees, like I don't think that would be possible. And so seeing new people, like we just hired Kristen Dunbeck from like Point 72, and she's joining to be a generalist like we are, more often than not. But she also was in the defense tech group at Point 72. So she kind of supplements our team in that way, which we think is important. And, we've had Matt and Anish over time. Both those guys were hired like 5-6+ years ago. And just to see like everyone excited by this change, like willing to double down, loyal to Silverton and the strategy, is just super rewarding, because like we've had some tough years here, like for venture investors, like 22 to, today, hasn't exactly been like an easy experience, like less exits, which means like less carry and less comp for people. And so like the golden handcuffs aren't as strong as they were in the past. And, maybe at some point the streak we have will be broken, but like to see us not have that turnover in a more difficult period in the industry and everyone kind of double down behind the strategy, probably the thing I'm like most proud of.
All right, so 5 questions, and then we'll close our time out together. What is one morning ritual or habit that helps you think clearly and lead effectively?
I am a big fan of like the cold plunge routine. So like, hopefully I have enough time for like a quick workout in the morning, and then I'll go jump in the plunge, and just kind of get ready to go. If I have a ton of stuff going on and I don't have time for that, like I'll just go, I'll go jump in there. But I kind of feel like it gets rid of the fog.
Yeah, no, that makes a ton of sense. What is a book or idea that shaped your investment philosophy?
I'd probably give credit, like I mentioned, Bill Wood, who was kind of like the guy that recruited me down to Austin. He was always very much, and I've taken on that mantle hopefully as well, of being like super entrepreneur friendly, and like everybody talks that walk, not necessarily like kind of acts in that. And like one of the examples that he gave me super early on is like most of the damage, between investors and founders or executives comes in these kind of like not optimal outcomes, where it's like, hey, the investor made a mistake and now they're trying to get back 1.4 times their money instead of 1 times their money, or like they're trying to get their money back instead of 0.7 times their money. And they're creating a lot of conflict with founders around like whatever economics are associated with like those small gains. But I had seen that a couple times, like some of the AV Austin Venture stuff was going on, and I had heard that from founders. And what he kind of told me, which made total sense, is like, you're going to succeed or fail in this business based on your winners and not whether you got back 1.5 times or 1 times on your losers. Like if you actually do the math on those equations, like that's not what's going to drive it. So like do the right thing for the entrepreneur. Like don't be, greedy in those circumstances. Like be generous, be a human. So I've tried to do that. And it's a good lesson, it's like show grace and be kind when it's difficult, because, entrepreneurs are the ones that really do the work and spend the time. And so to sit there at the end of the day and like try to punish them for some outcome, or, be greedy with economics, I see it happen all the time, but it's just the wrong thing.
Being a human and being showing some grace is definitely, I think everybody can always remind themselves of that in certain situations. And I know we kind of touched on this earlier, but I'm curious maybe if anything has popped up in between in terms of kind of a lesson from a tough deal or decision that has stayed with you.
We had this company called Outbound Engine, and it was kind of like an automated marketing product, real estate agents or other folks would use to do like content-based, like drip marketing. Um, and it grew really quickly. It was primarily like inside sales driven, like the approach to it, but it was never like a super retentive product, meaning like it always like churned out at a certain rate. And, but yet despite this, like early days, it was still growing at like 3x a year, and it was super exciting. And then what you realize, which I learned early on, like this was early on in my investing career, is like that churn dynamic where like you don't quite have perfect product market fit, and the subset of customers you're dealing with like maybe aren't that wedded to the product, or maybe they're just not the best customers because they're going in and out of the industry. We eventually like hit the wall with that business, like maybe around like 25, 26 million. And it was because like, hey, we were churning 10 million or whatever it was, 8 or 10 million a year. And it just becomes like too much to replace. And so you have something where we're like, hey, this is working. We're scaling. We got in pre-revenue and now we're at 26 million. We ought to be excited about this. And you learn really quickly that like one fly in the ointment with respect to like that super important attribute of the product can kill everything. And so when you see something like that as an investor, it's like, okay, well, like every single deal I do from like this point forward, like this is going to be a cornerstone element of like what I assess in that business. And it was just the maturation of like software. Like people were talking about churn in 2011 or whatever this was, but now it's like PE firms wanting to touch companies that have gross churn below like, or like gross retention above like or below 90%, and it's become like a manufactured artifact of like how software investing is done. And so like someone had to figure that out for the first time through trial and error. And I feel like in some ways, like that was me, and it stuck with me for quite a while.
Awesome. And it could be, this question could be a current company you're working with, or maybe a founder you're going to be working with soon. But is there anybody that, from a founder or company perspective, that you've recently worked with that is like very inspiring and exciting to you, and why?
Probably the best like people manager is Mark McLean, the SailPoint CEO. We forget that like communication and being a good leader, like we almost assume like people should know how to do that by default. And like some tech companies like honestly have the worst leaders, not in terms of like vision and strategy, but just like how they treat people and how they manage people. Like there's very few people that I would hold up and say like that person is just like a good leader of people, like fair to employees, communicates super well, takes, the real people element into account with like every decision. So like I want to give a shout out to him because I think he's super special. The other one, we have an investment in a company called the Helper Bees. This guy Char, who is the founder / CEO of that business. He has it's a aging in place marketplace. So it's a suite of services that help people stay in their homes longer. He has like a personal attachment through his own experience to that market, which I always think is super powerful, but it's persisted through. So like, there aren't a lot of founders where if I text them at like 11:30 PM with a question, like they're going to respond within like 5 minutes. And he's like one of those guys, and he's been at it for a while. And I think we've been an investor in the company like 6 years. I think he's been at it like 7 or 8 years. And so sometimes people start that way, and then they like, even though they have a personal thing, like they lose their passion like over time. But the people that have the motor where it's like 8 years into it, they're still like cranking 100 miles an hour in speed and responding that way, and as passionate about the mission as the day they started the company. Like I give him a lot of credit for that.
And last question, in your own words, define what built for this means to you.
We're at a stage in history where like the future is like more ill-defined and wide open than it has been in a while. Like we had all these kind of hypothetical questions about what's going to happen with AI and what does that mean for employment and how are these industries going to change and like what it means for like broader humanity. I don't think there are that many points in tech where you could kind of point at a moment and like the implications are like vast and broad. And like, we're investors, we're capitalists, like everyone's talking about like making money and how to capitalize on these opportunities. And you kind of asked some questions that we didn't really get too much of a chance to get into around just like the humanity of it and like what kind of world we want to create. And I kind of feel like over the next 5 or 10 years, like there's a lot of decisions about like what paths we take and what implications that has for the future. And like as an investor, I can play a little role in that because like I'm a capital allocator, but like the founders and entrepreneurs are going to be like the ones that create the companies that bend the world like in one way or another. And so like just be thoughtful about it because it's, like in retrospect, like we look back on, I don't know, at least I do on like, things like, Facebook or Instagram and like, produced a ton of profit, like, but what implications have those had on society? And like, it's almost like a futile discussion because it's like, we can't go back and change it. It is what it is. But like at this point in time, we do have the opportunity to change it because like those changes haven't happened yet. So just, I would encourage everyone to be thoughtful about that as we proceed forward. So.
Absolutely. Intention versus impact for sure. Well, I appreciate you taking time and it was so great to learn more about you, your experience, and how Silverton looks at deals and founders. And so for anybody listening, if they're curious to learn more about your firm, your funds, or any of your deals, what is the best way for them to connect and learn more?
Yeah, I mean, the easiest, like we're on all the social platforms, but we also have a website, silvertonpartners.com. We take submissions for business plans via that. I think the best platform for me personally is probably like LinkedIn in terms of like reaching out and sending stuff in. And then the rest of our employees, some of which I gave a shout out to, and this are also listed. So like Anish and Matt and Addie and Kristen, like they do a lot of the first cuts on all our deals. So like feel free to reach out to them directly. Would love to hear from you.
Amazing. Thank you so much. It was great to connect with you.
Yeah, I really appreciate the time. Enjoy the conversation. Thank you.
Awesome.